So, Chandni, we are live now. And hello, friends. Good evening, everyone. I welcome all of you in our today's session. And our today's session is on Ind AS 116, which is on the leases. And I welcome all the participants, those who are available right now. And I welcome Alok Gargji as well. I think Alokji is also here. He's also replying in the chat box. So welcome Alokji and welcome Jabirji as well. Uh, and our today's session, we had 2 days series on the Ind AS. So one session Alokji has taken on the Sunday, and second session is on today, which is on the Ind AS 116 leases. So today's session will be taken by CA Chandni Gupta. She will take us through and elaborate us the Ind AS 116, which is on the leases. So before moving on the this presentation and webinar, let me first give you the introduction of Chandni Gupta. CA Chandni Gupta is qualified with All India CA rank in CA Final and CA IPCC both, and she has secured All India rank 3 in Global Financial Reporting Standards, mainly in IFRS, and she has secured 74% marks in Financial Reporting, Ind AS, and currently she is pursuing diploma as well from IFRS, ACCA London, UK. She is graduated from Delhi University and secured first rank in Commerce Senior Secondary School in school. Uh, Also, she has working experience, having experience in financial planning and analysis and business finance of various lines of business of OYO rooms under financial leadership program. She has vast experience in audit of various listed entities, private companies during articleship with GT. She has gained a lot of experience, and she has experience in implementation of Ind AS as well on the listed companies, and she has prepared financial statement in compliance with IGAP for various entities as well. So she is having huge experience of Ind AS and IFRS, and she has also contributed in a comprehensive book. Uh, Treatise on Ind AS explained with the practical examples and MCQ that we have discussed on our day one session on Sunday, which has been written by CA Alok Gargi and which has been published by Bloomsbury Publication House. In that book, Chandni has contributed a lot. She has given a lot of contribution in this book. So I congratulate Chandni to be part of this book and for her contribution to the book. And she has also delivered various sessions on various platforms of ICAI as well as for CASA channel, which is of the Sumit Garzi's platform. And she has given the deliberation on for Ramanuj College of Delhi University. So, and on the personal front, she has also founded one YouTube channel with the name called IFRS World as well. So on that, she is very active and sharing very good videos on IFRS. So this was all about the Chandni. Now, before moving further, I just want to tell all the participants that about the book in which she has been contributed. So those who want to purchase this book, you can purchase this book. This book is right now available on the pre-booking, and link of the purchase of this book I've shared in the chat box. From मेरी पुस्तक डॉट कॉम से आप ये book purchase कर सकते हैं. The cost of book is around 3,000, and right now I guess 25% discount is going on, which is a pre-booking discount. So anybody who wants to avail the services, wants to purchase this book, they can purchase this book from the मेरीपुस्तक.com. Link मैंने chat box में दे दिया है. Chandni also contributed a lot in this book. Alok ji is the author of this book. Bloomsbury has written this book, and more than 1,000 MCQ, जो कि जैसा कि आलोक जी ने बताया था, they have incorporated in this book. And now I'll request Chandni to start her deliberation. Also, कुछ अपना experience if she would like to share on the book की how was her journey for last 2-3 months when she was part of the book. So that also I would like to hear from you, Chandni. Over to you, Chandni.
Thank you so much, Deepak sir. Thank you so much for such a wonderful introduction. And yes, it's my pleasure to be a part of this webinar, and it's wonderful. It's my honor to speak on this platform. So about this book, first of all, let me talk about Alok sir, who is the author of this book. So he has written this book so comprehensively. I mean, this book covers all the Ind ASs with such simplified language, and we have covered all the Ind AS which are updated. So, recent notification which was issued by MCA on 24th July, that amendment notification is also covered in this book. This book includes 1000 MCQs and 1000 MCQs on all the indices. Like, it covers all the indices. So if you need to revise it quickly, you can just go through all the MCQs, and I'm sure you'll get an overview of the index. And also, it includes comprehensive comparison between index, IGAP, IFRS, and also ICDS. So this book contains a lot of things, and also a lot of practical case studies based on education material and ITFG bulletins. So if you need to learn in depth about Indias, I guess this is the book that you should be buying. And yes, my experience working with Alok sir on this book has been wonderful. It has been a great learning experience. Like, I don't think anybody gets such an experience so early in their career. And I am really grateful and thankful to Alok sir for giving me this wonderful opportunity. So yes, so this was about the book.
Thank you, Chandni, for sharing your journey as well as telling us about the book. So now, those who want to avail the benefit of this book, you can purchase this book from the pre-booking. It is there. Link I have shared in the chat box. Also, after the end of the session, I will share in the description as well. PPT also we will upload today's PPT on our Telegram channel, Study Cafe. Link of the same also I will share with you, and I humbly request all of you to join this channel, subscribe our YouTube channel, and also please like this video. Now over to you, Chandni. You can start your deliberation. Your PPT is live. PPT participants can see.
Okay, thank you so much, sir. So, once again, everyone, welcome to this webinar. Today, we are going to discuss Ind AS 116, which is on leases. So, we will try to get overall end-to-end coverage of this particular standard, and we will first of all start with the origination, like from where this standard has come and why this standard has come. So let's begin with the origin part. In 2005, the Securities and Exchange Commission, which is the Exchange Commission of USA, their staff recommended the FASB, which is the Financial Accounting Standard Board of US, and the International Accounting Standard Board to revisit the accounting guidance for leases. Why this happened? Because the staff of SEC conducts various analysis of the off-balance sheet financing of the financial statements which are submitted by the companies in USA. After the analysis of certain companies, like they took a sample of 200 companies, 100 large companies, and 100 random bases. The analysis of those 200 companies, they figured out that 70% of the companies are using operating leases, and operating leases are basically off balance sheet leases. So what happened before Ind AS 116? There was the standard Ind AS 17 on leases. As per Ind AS 17, the leases were required to be classified into two parts: finance lease and operating lease. Finance lease, in finance lease, the lessees were required to reflect a asset and a liability on their balance sheet. But in case of operating leases, they were not required to show any asset or any liability on their balance sheet. What they were required to do, they were just required to expense off the lease rentals that they were paying. So consequently, what happened, 70% of the companies which were dependent upon operating leases were not showing any liability or any asset on their balance sheet. And then what happened, there was no transparency. The investors were not able to compare the companies which were taking loan to buy an asset and the companies which were taking assets on leases. There was no comparison, because for the companies who were taking loan to buy an asset, there was a liability on the balance sheet, right? But for companies who were leasing the assets, there was no liability on the balance sheet. So this kind of comparison was not possible. Therefore, in order to bring transparency in financial reporting, in order to give a better financial information to the users, the boards, FASB, which is the Accounting Standards Board of USA, and International Accounting Standards Board IASB of UK, they collaborated and they replaced the earlier accounting standard with a new accounting standard. So in 2006, it took almost a decade for IASB to introduce new standard on leases. So it took a lot of analysis, a lot of research, right? So in 2016, IASB introduced IFRS 16, which replaced IAS 17. So we all know that in India, 2015 was the year when MCA issued Indian accounting standards, Ind AS. So day before yesterday, Alok sir gave an overview about Ind AS, right? And in that session, he explained how the convergence happened, what all amendments have been issued after the issuance of these standards, right? So this accounting standard, Ind AS 116, is based on IFRS 16, and IFRS 16 was introduced in 2016, which was made effective from 1st January 2019. And in India, Ind AS 116 was introduced on 30th March 2019 and was made effective from 1st April 2019. So that's how Ind AS 116 was brought into existence. So in short, from 1st April 2019, the application of Ind AS 17 has been discarded and the application of Ind AS 116 has been started. Now let's understand why, what has really changed between Ind AS 17 and Ind AS 116, what has changed and why it has changed. So I just gave you an overview, like to bring transparency and to improve the financial reporting, right? But what has really changed? So in Ind AS 116, the accounting for lessees has been changed significantly. Like it has been totally revamped, and accounting for lessors has not changed that much. Only the disclosures have been enhanced. For to understand the changes, we will be talking about the accounting for lessees only. Now, what has really happened? So earlier, Ind AS 17, in Ind AS 17, in case of operating leases, the lessees were not required to show any asset or liability, right? It was more of an off-balance sheet financing. Now in Ind AS 116, all the lessees are required to capitalize all the leases. So basically, what they have to do is they have to show an asset in their balance sheet for almost all the leases and have to show a liability for almost all the leases. So there are certain exceptions for like short term leases and low value leases, but more or less majority of the leases will be now capitalized and will be brought from off balance sheet to on the balance sheet. Right now, is there any change in the definition of leases? Because now, since there has been a huge and sudden change in the accounting of for leases altogether, so is there any change in the definition for leases? So there is a small change. In Ind AS 17, the definition of leases was that it is a contract in which the lessor conveys a right to use the asset to the lessee. But in Ind AS 116, it says that it is a contract in which the lessor conveys a right to control the use of the asset. So basically, a concept of control has been added in Ind AS 116. But what about the leases that were already into existence as on 1st April 2019? Because that's when the Ind AS 116 was applied, right? So Ind AS 116 has clearly given a practical expedient, and an exception, an exemption has been given that you are not required to reassess the contracts of leases on 1st April 2019. So the leases which were the contracts which were considered as leases as per Ind AS 17 will continue to be considered as leases as per Ind AS 116. So there is an exception has been given to the entities. So this is kind of a relaxation. Now, as I told you that off balance sheet has come on the balance sheet of the lessees, right? And that is for majority of the leases. For the operating leases, that was a 70% part of the total leases in the world, right? So how the balance sheet will look like? If you can see on the screen, in Ind AS 17, in finance lease, the asset was there on the balance sheet, liability was there on the balance sheet. That's fine. But in case of an operating lease, there was no asset on the balance sheet and no liability on the balance sheet. But there was a disclosure required in the notes, and hence we said that the operating lease used to be an off balance sheet financing. But now, in Ind AS 116, all the leases are required to be shown on balance sheet. So asset will come on the balance sheet of all the lessees and liability will also come on the balance sheet of the lessees. Now I want to understand from all of you that between 31st March 2019 and 1st April 2019, a sudden liability and sudden addition in asset has come in the balance sheet of lessees. So, what will be the impact on the financial ratios? Which financial ratio will be impacted? I want to understand from all of you. Please write in the comments. Let's make this session interactive and so that it will be better for understanding of everyone. Please tell me what all financial ratios will be impacted due to sudden increase in liability and sudden increase in asset. Right? I request everyone to take part. Absolutely right. I am getting the answers. Yes. So basically, debt equity ratio. Debt equity ratio will be hugely impacted due to this transition. And of course, asset turnover ratio, yes. Equity ratio is one of the widely used ratios that will be impacted due to such a transition. Now, what has been the impact on statement of P&L? Let's understand. As per Ind AS 17, in case of finance lease, since there was already an asset and already a liability, for asset, it was depreciated over the period of lease. So already there was depreciation recognized as an expense. And in case of liability, interest was charged on the liability. So there was already a finance cost in the P&L. But in case of operating leases, there was no depreciation, no finance cost because there was no asset and no liability. But there was an operating cost because whatever the rental, whatever the lease rentals the lessee was supposed to pay was charged as operating cost, as rental expense. So there was an operating cost. Now, in Ind AS 116, since the concept of operating lease has been discarded completely, right? So now what happens is this expense of rental in the operating cost will be bifurcated into depreciation and finance costs. So in the P&L of lessees, as per Ind AS 116, depreciation will be charged and finance cost will be charged. Now, as a result, what happens? The EBITDA, which is widely used business metric for companies, will increase. Why? Because the operating cost has been reduced, right? So the EBITDA will improve and operating profits will also improve. Why? Because finance cost has come in the statement of P&L, which will impact PBT and not the operating profits. So as a result, what has happened is EBITDA has improved, operating profits have been improved, depreciation and finance cost has been added. This is the change from the transition from Ind AS 17 to Ind AS 116. Mr. Harsh Dedia, no impact on P&L. So there will be impact on P&L as we just discussed. the EBITDA will improve and the operating profits will improve. Right. Now, moving on, what has been the change in statement of cash flows for the lessees? So when we talk about finance lease, obviously nothing has changed. The outflows from operating activities still there, and outflows from financing activities still is also there. But in case of operating leases, the entire rental expense was recognized as an outflow from operating activities. But in case of Ind AS 116, it has been bifurcated and depreciation is recognized in operating activities and finance cost has come to financing activities. And as a result, operating outflows from the operating activities has reduced and outflows from financing activities has increased. This has been the impact on statement of cash flows for the lessees. I hope we are able to understand the transition from Ind AS 17 to Ind AS 116. Let me know if you have any queries. Otherwise, we will move on. I request everyone to please take part and make this session interactive so that even I know that you are able to understand this. Okay. So, as we understand that now the lessees are required to capitalize all the leases, and there will be an additional depreciation and additional financing costs in the financial statements. Now, these are certain industries that have been highly impacted. Why? Because these industries used operating leases for majority of their assets, like airlines, aircrafts, like majority of the uh, in fact all the airlines used to lease their aircrafts, right? So airlines is one industry. Then oil and gas, the huge infrastructure was on a lease basis, and now all the infrastructure will come on the balance sheet. Retailers, then telecom and information technology, IT, these industries have been hugely impacted due to the transition. When okay, so do you want me to repeat? So we were discussing that what has been the impact on the financial statements for the lessees. In case of balance sheet, an asset has been added and liability has been added. In P&L, finance cost has been added and depreciation has been added. And in cash flow statement, operating cash outflows from the operating activities have reduced and cash outflows from the financing activities has been increased. Right, this has been the impact on the financial statements due to transition. Now let's move on and understand what is the scope of Ind AS 116. So Ind AS 116 clearly applies to all the leases, including subleases that we will discuss later in this session, except for leases relating to minerals, oil, natural gas, and similar non regenerative resources which are within the scope of Ind AS 106. Then biological assets as per Ind AS 41, then service concession arrangements which is as per Ind AS 115, licenses of intellectual property, then other intangible assets like motion picture films, video recordings, plays, etc. So these all are out of the scope of Ind AS 116. And also, one option has been given to lessee that it may not apply this standard on any of the intangible assets. Right? So this option has been given to the lessees. Now, since this standard has brought all the leases on balance sheet, like the concept of classification has been discarded, right? But this standard also gives an exemption to the lessees. So as per these exemption, there are two kind of leases. Number one is the short term leases. What is a short term lease? A lease which has a lease term of 12 months or less, and the other is low value leases. Low value leases is basically leases which have an absolutely low value, right? and we have to assess the value of lease when the asset was new. So suppose I have taken a car on lease, right? And that car is basically a second hand car. Now, when I take a second hand car, the value is obviously lesser than what it would have been had the car been new, right? So I need to check the value if the car would have been new. If the car would have been new and the value would have been low in terms of absolute figures, then it would have been considered as a low value lease. So, for all the assets, we need to assess if the asset was new, then whether the value is low or not. There is no monetary threshold that has been prescribed in the lease. It depends upon the nature of the asset and nature of the industry. So, for example, generally like tablet, mobile phones, PCs, office items, these are all considered as low value leases. So, now what happens with these leases if not capitalized? Now, these leases will be treated similar to as operating leases in the former standard. So, the lease payments for these leases will be recognized on a straight line basis and will be expensed off when incurred, right? So there is no concept for capitalizing these leases, but this exception this these exemptions are optional, and if the entity wants to capitalize, then it can also go ahead and capitalize these leases. Yes, sir. The low value means the assets capable of being used independently. We have to see if the asset is capable of being used independently. Now let's understand the timeline of the lease. So, first of all, there is an inception date of lease. This is the date on which the lease agreement is signed. Basically, this is the date on which the principal terms and conditions of the lease are agreed between the parties, right? And on this date, there are two things that the entities are required to do. Number one is they identify the lease. So, what it takes to identify the lease, there is a whole lot of assessment and a lot of analysis goes by to analyze and assess if a particular contract contains a lease or not. Second thing that entities are required to do is classification. Now remember, this classification is needed to be done only by the lessor, because there has been no change in the accounting for leases by the lessor, but the classification of lease by lessee has been discarded. They are not required to classify the leases anymore. So this classification into finance or operating lease is required to be done only by the lessor. And when he will do this, he will do this assessment on the inception date, the date on which the principal terms and conditions of the leases are agreed by the parties. Yes, Aditya, the low value asset will be treated in old times, right? As just like the operating leases. Now, after the inception date comes the commencement date. Now, what is the difference between inception date and commencement date? Commencement date is the date on which the lessor makes the underlying asset available for use by the lessee. Right, this is the date on which the asset is sent or delivered to the lessee, and lessee is now free to use that asset. These dates can be different or they may be the same date. Now, on this date, what the entities are required to do? They are required to determine the lease term, and they are required to initially recognize the lease. Right. So on inception date, the lessees are required to identify the lease, whether the contract is contains a lease or not. The lessor is required to classify the lease into finance lease or operating lease. And on the commencement date, the entities are required to determine the lease term. So basically, the lease period starts from the commencement date, and they are required to initially recognize the lease. Now let's understand how to identify a lease in a contract and what is basically the definition of lease as per Ind AS 116. So basically, there are five components in a contract to be considered as a lease. Number one, it should be a contract, obviously, between two parties or more. Second part is that there should be a right to control the use. The contract must convey the right to control the use of the identified asset. So we need to understand the right, what is a right to control and when does it come, and what is an identified asset. So we will understand these two concepts very comprehensively. Fourth leg is period of time. So obviously there is a lease term which starts from the commencement date, right? And last part is consideration, obviously the lease payments that the lessee is required to make to the lessor. So these five components make a contract lease, right? So lease is basically a contract that conveys the right to control the use of an identified asset for a period of time in exchange for some consideration. Now we need to understand how to identify whether the lessee has a right to control the use or not. So there are two components which makes the lessee which makes the lessee to have a right to control use of an asset. First is right to obtain substantially all the economic benefits from the use of the identified asset. And second is the right to direct the use of the identified asset. Now, these two rights, number one is to obtain substantially all the economic benefits. What is economic benefit? Economic benefits are basically uh, all the benefits that an entity or a person can derive from the use of an asset, be it in terms of its primary output or its byproducts, right? And or any other benefit for that matter. And how to derive that economic benefit? It may be from the use of that asset, or by holding that asset, or by subleasing that asset, right? For example, I have taken a car on lease, and now whether I drive it myself, I give it to Ola or Uber to drive, or I just hold that asset, it's up to me whatever I want to do. But whatever receipts come from the use of that asset comes to me. So basically, I have the right to obtain substantially all the economic benefits that one could have derived from that asset. So whatever possible economic benefits are there from that asset will be derived by the lessee. If that condition is fulfilled, then we can say the lessee has a right to obtain substantially all the economic benefits from the use of that identified asset. Second leg is right to direct the use of the identified asset. Now, when does it come and how does it come? So, we need to analyze and assess if the lessee has a right to direct the use. Right to direct the use comes when there is a right to direct how and for what purpose the asset will be used. So basically, if a lessee can decide that how that asset will be used and for what particular purposes that asset will be used, then we can say that the lessee has a right to direct the use. For example, I have taken a property on lease and I want to build a restaurant on that. Right now, it's up to me whether I want to serve vegetarian food in that restaurant or non-vegetarian food in that restaurant. Right? It's up to me what timings will be of the restaurant, what days will be days on which the restaurant will be open. Right? I have the right to decide the use of that asset and the how the asset will be operated. If that right is with me, then I can say that I have the right to direct the use of that asset. So sometimes it happens that these decisions are predetermined, right? When the contract is signed, these decisions are predetermined, and the lessor and lessee, both of them agree to these decisions. But now, can we say that the lessee in this case has a right to direct the use? We can say how, if the relevant decisions about how and for what purpose the asset is used are predetermined and the customer has the right to operate in the manner. So basically, the decisions are predetermined and lessee has a right to operate as per those instructions, and the lessor has no right to alter or change those operating instructions. So if this is the case, then also we can say that the lessee has a right to direct the use. And also, if the asset has been designed by the lessee for its own use only, like it's a customized asset, right? It can be used by the lessee only. In that case also we can say that the lessee has a right to direct the use. So we need to assess this depending upon the facts and circumstances of the case. Now, these rights need to be valid throughout the period of use. This term, throughout the period of use, is very, very important. Period. For example, say I have the restaurant that I built on the property I took on lease. I have a right to decide that I will be selling vegetarian food or non-vegetarian food in that restaurant, right? And the lease term was 5 years. But as per the contract, after 3 years, the lessor has a right to tell me that I cannot sell non-vegetarian food. So in that case, what happens is, for 3 years only, I have an exclusive right. But for rest of the 2 years, I don't have an exclusive right? So in this case, the contract will be considered as containing lease for only 3 years of lease accounting. Now, generally, what happens is, in the contract there are certain protective rights that have been given to the lessor. Uh, for example, a company has taken a machinery on lease, and as per the contract, there is a limitation on the production. For example, the lessor can stop the lessee from using that machinery after the production of 1 lakh units in 1 year, right? So is this condition, is this right of the lessor to restrict the production will affect the right to control the use of asset by the lessee? Please answer in the chat box and let me know whether this right of lessor to control the production units will restrict the lessee's right to control the use of asset.
Friends, please revert in the chat box so that we can make this session interactive. Otherwise, it will be only one-way communication. So you all are very interactive since long time, and we can see that today also you are taking part of it. So please quickly revert
Okay.
for the answer so that we can make the session
Okay.
more interactive.
Yeah, answers are coming. I guess
Now
there was
answers are
some
coming,
network
sir.
glitch. Okay. This should be considered as protective right.
Yes.
Absolutely correct, Ramesh ji. Yes, after 1 lakh units. Okay. So let me tell you guys, this restriction, right, that the lessor has is just a protective right. Why? Because after the production of 1 lakh units, the machinery will break down. Right. This is just to protect the interest of the lessor. This is just to protect the asset. So even in that case, it will be considered that the lessee has an exclusive right to control the use of asset. So whenever there is a situation like this, we need to see whether the lessee can control the use within the defined scope of the lease contract. So this 1 lakh maximum limit of 1 lakh units production is just what? Is just a limitation, is just a upper cap, right? So if the lessee can derive the benefit, all the benefits within this defined scope of 1 lakh units, then we can still say that the lessee has a right to control the use. Okay. Now I have a question for all of you. Now I request everyone to take part and please give me the answer for this question. So, what this question says is Company A has taken a car on lease from a supplier for 5 years. Right? Company A has taken a car for 5 years on lease. The car is identified in the contract, and supplier has no rights to substitute the car unless it breaks down and requires operational repair and maintenance. That's fine. The car is an identified asset. Now, the car will be driven by the company A drives the car or hires a driver. So basically, company A decides whether to drive the car by themselves, or they want to hire a driver to drive that car. Second is the company decides how to use the car as to where it will go and what it will carry, and also has exclusive rights to change these directions throughout the period of use. So basically, Company A has taken a car on lease for 5 years from the supplier. It is an identified asset as per the contract. The company A decides whether it will drive the car by themselves or will hire a driver. Also, company decides how the car will be used, where it will go, and what it will carry. And in fact, all the rights regarding changing these directions are with the company A. The supplier prohibits certain uses of the car. For example, maximum limit to drive is 1000 kilometers, because beyond that, the car will break down. Now, whether company A has the right to control the use of the car throughout the period of lease? Just a yes or a no. Okay, right. I am getting some correct answers. I request everyone to take part so that we can understand if you all are able to understand this or not. Okay, I am getting a lot of answers now. Okay, great. Great. Yes. So, right, absolutely. Company A has the right to control. Why? Because the company A has a right to substantially all the economic benefits from the use of the car, because it can control the use. It can decide whether the company themselves want to drive the car, or they want to hire a driver to gain the benefits, right? They have the access to all the economic benefits. Second is they have the right to direct, because they can change the decisions regarding how the car is used and where it will go and what it will carry throughout the period of lease. So for entire 5 years, we can say that company A has a right to control the use. And with respect to the supplier's rights of limiting the use of car for maximum 1 lakh kilometers is just a protective right. Why? Because after that the car will break down. So we need to see whether company A is able to derive the benefits within 1 lakh kilometers or not. So in this case, the company A has exclusive right to everything. So we can say that the company has a right to control the use, and yes, there is a lease in the contract. Right. Now, I hope we all understand how the right to control is assessed and where it comes from. Now we need to see what is an identified asset and whether it actually is an identified asset or not. Because if there is no identified asset, then we cannot say that the contract contains a lease. Now, as per Ind AS 116, an asset can be explicitly identified in the contract or implicitly specified in the contract. It means that all the specifications regarding the asset, be it its nature, brand, size, color, all the specifications that are necessary to define that asset is there in the contract, is mentioned explicitly in the contract. Right, this is first leg when we can say that asset is explicitly specified in the contract and there is an identified asset. But what happens when there are no specifications specified in the contract? So there could be some cases. For example, I want to take a truck on lease, and I'm very particular about the specifications of the truck, uh, with respect to its capacity, its size, right? Because I need to use that truck for a specific purpose which requires a certain capacity to be there. Now I go to a supplier which happens to have a lot of trucks, and and we talk about my specifications, and he tells me that okay, I have just one truck that meets all your specifications, and we sign an agreement that this will be the lease term and these will be the lease rentals, right? Now, but what we do not do is we do not mention the specifications of that particular truck in the contract. Now, can we say that it is an identified asset? Can I say that the truck is an identified asset in this case? Uh, Please answer in the chat box. I guess there is again a network glitch. So, guys, this truck is still an identified asset. How? Because both the parties are aware that there is just one truck that meets the specifications of the company, right? And even though it is not specified in the contract, but it will be made available for use when the time comes. So we can still say that it is maybe it's not explicitly specified, but it's still implicitly specified, right? Great. Yes. So we understand now that asset may be explicitly specified in the contract with all the specifications mentioned in the contract itself, or it may be implicitly specified and it will be made available for use when the time comes. Right. So this was the story of the identified asset. But there is one exception. When when the supplier has a substantive right to substitute that asset throughout the period of use, then we will say that no, this is not an identified asset. Now, when does it happen and how does it happen? Now, suppose a company has taken a machinery on lease, and as per the contract, the lessor has a right to substitute that asset. What does it mean to substitute that asset? That it can just replace the asset, it can just replace that machinery and give another machinery in place of the old machine to the lessee. Right. Now, as per this contract, the supplier, the lessor has a right to substitute that asset. But now we need to see whether this right is actually substantive, whether it is actually beneficial for the lessor to substitute that asset or not, and whether it is practically, whether the lessor is practically able to substitute that asset or not, right? So even though a supplier or a lessor has a right to substitute the asset, but we need to see if those rights are substantive or not. So say in that case the lessor wanted to replace that machinery, but what are the factors that it is need that are needed to be considered? Number one, the machinery is very heavy, right? It is installed in the premises of the lessee, it is installed in the premises of the company. There will be huge cost associated with the installation of the new machinery and removal of the old machinery, and then of loading, unloading. So there is a huge cost associated with that, right? So lessor is required to assess if the removal and substitution of that machinery from the premises of the company is beneficial or not, whether the cost is huge or not, right? And if this is the case that it is beneficial for the lessor, and lessor has another asset, another machinery readily available to replace the old machinery, then in that case the rights are substantive, and then we will say that no, machinery is not an identified asset, and there is no asset in our lease. Now, again, as I mentioned earlier, in case of rights, that these rights are needed to be valid throughout the period of use, right? So in this case also, the supplier has to have these rights throughout the period of use. If these rights are anyhow dependent upon any condition or any event, in that case these rights are not substantive, right? So there has to be a freely exercisability of those rights. Now moving on, now I hope everyone has understood the concept of identified asset. Can we move on? Yes, okay. Please write in the comments so that I know that you guys have understood this, and then we will just move on. Okay, guys, so let's move on. Now, we have understood the rights to control the use of asset and the identified asset, the concept of identified asset. Now, we just need to understand the lease term. So, when we understood the concept of commencement date, we understood that on that particular day, the entities are required to determine the lease term. What does that mean? That it means that the lease term starts from the commencement date, right? So in this case also, when we calculate the lease term, our timeline will start from the commencement date. It will include the rent free period if there is any, and it will include the renewable period. But there is a condition attached to it. Renewable period will be included only if the lessee is reasonably certain to exercise that option. So the lessee is required to assess whether it is reasonably certain to exercise the renewal option or not. If it is reasonably certain to exercise the option, then we will consider the renewal period also. Third, last leg is when there is a termination option in the contract, then the lessee is required to assess whether it is reasonably certain not to exercise that option. What does that mean? That the lessee is not going to exercise the termination option. If that is the case, then we will cover the period. We will include the period covered by the option to terminate in the lease term. So basically, lease term is the non-cancelable period. Non-cancelable period means the period which is enforceable, right? And it starts with the commencement date. It includes the rent-free period. It includes the renewal period if the lessee is going to renew that lease, and it includes the period beyond the termination option if the lessee is not going to terminate the lease. Now, there is one thing that we need to understand about the termination clause. There are different types of termination clauses included in the lease contracts. First is when both the parties have a right to terminate. What happens in that case? So, if both the parties have a right to terminate without any major penalty, then is the contract non cancelable for a long period? No. Why? Because after a certain date, the date on which this right becomes exercisable, after that particular date, any of the party may terminate that lease and no party is liable to make any payment, right? There is no penalty attached. So after that particular date, the contract becomes non enforceable. It becomes cancelable and becomes non enforceable. So only till that date, when the rights become exercisable, the term will be considered in the lease term, right? Because that is the term during which none of the party can terminate, or if they want to terminate, there will be a huge penalty attached, right? Now, what happens if only the lessee has the option to terminate? So as we discussed, while determining the lease term, when there is a termination option with the lessee, it is required to assess if the lessee is going to exercise the termination option or not. If the termination option will be exercised by the lessee, in that case, what happens is the lease term will be for the period only till the termination rights become exercisable. Right. But what happens if only the lessor has a right to terminate? Now, this is very interesting. If the lessor has the right to terminate and lessee does not have a right to terminate, in that case, his right is completely ignored. The lease term, will include the period which is covered by the option to terminate. Why? Because it is assumed that the lessor will not terminate. And that too, why? Because in this case, the lessor has rights to earn the lease rentals. Right? If the lessee has an option to terminate, the lessor does not have an unconditional right to earn the lease rentals, because lessee might terminate the lease anytime. But if only the lessor has a right to terminate, then the lessor has an unconditional right to receive payments. Right? Because until unless the lessor exercises that right, it will receive the lease payments. So in that case, the rights of the lessors are completely ignored. I hope your query is resolved, Mr. Jebir. Okay, so now we will understand the entire lease term concept with an example. Suppose Domino's has taken a property on lease in Gurgaon to open up an outlet, and the lease agreement has been made for 5 years. But there is a renewal clause in the agreement. And what does that renewal clause says? It says that after 5 years of the lease contract, the lessee, the Domino's, has an option to renew the lease term for another 5 years. So that makes it 10 years, right? But also there is a termination clause wherein Domino's have a right to terminate. That means only the lessee has a right to terminate the lease. And what does this clause says? That after the expiry of 3 years from the date of agreement, the Domino's have a right to terminate the lease without any penalty. Right. Now, Domino's, since has taken a property on lease in Gurgaon, they have done all the interior designing, because all the outlets of Domino's have a uniform designing pattern. Right. They all look blue and red. So they have undertaken all the interior designing part. They have incurred huge costs with that. Now, what will be the lease term? In two cases. Case one, when Domino's estimates a standing position in Gurgaon market for at least 15 years from now. So the case is, Domino's has taken a property on lease in Gurgaon to open up an outlet. They have incurred all the interior designing costs on the outlet. They have done all the expenses that it was required to make it look like a Domino's outlet. The lease agreement was initially made for 5 years. It includes a renewable clause for another 5 years, and it includes a termination clause that the Domino's can terminate the lease after the expiry of 3 years from the date of agreement without any penalty. Now, the case is that Domino's estimates a standing position and it sees themselves in Gurgaon market for at least 15 years from now. Now, what will be the lease term? Please write in the comments so that I know if you are able to understand this or not. I've got just one answer. Is this any technical glitch? Yes, yes. Okay. 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 Right. So I'm getting a lot of correct answers. Yes. So in case one, the answer is lease term will be for 10 years. Now, why is it so? Because when the lessee has a renewal clause and a termination option, the lessee is required to assess whether it is going to exercise these two particular options or not. Right. So in case one, since the Domino's estimates their position in the market, that they will be there in the market for at least 15 years from now. So they do not see any such situation where they need to close their outlet and go. Right. So in this case, we can say that Domino's will renew their agreement, and it will be for at least 10 years, because that is for how much the agreement has been made, right? So 5 plus 5, 10 years will be the lease term in case 1. And in case 2, Domino's is dicey about the location and is not expecting long standing. Now, in this case, what happens is there is a 5 years term with along with a 5 years of renewal clause and a 3 years of termination clause. Now, Domino's is dicey about the location. They've just started with their property in Gurgaon, and they are not expecting to stay there for a long term, right? So, what will be the lease term in case 2? Right, right. Okay, so I'm getting a lot of correct answers. Yes, it will be 3 years. Why? Because in this case, the Dominoes will assess and see that they might exercise their right to terminate. Right, so the non cancelable period in that case will be 3 years only. Because after that, the Dominoes is expecting to terminate their lease contract. Right, 3 years is the only period without penalty. If they want to terminate it within 3 years, they will have to incur penalty, and as well as they will have to like let go of their interior designing, right? There is a huge cost that they already incurred. Now again, they will have to incur penalty if they want to terminate the lease contract within a period of 3 years. So at least they will stay there for 5 years if they want to. Hence it will be 3 years. Right. Okay, so everybody is clear about the right to control the use of asset, identified asset, and the lease term. Now we are clear that how to identify a lease in a contract. We just need to see if the contract conveys a right to control the use of an asset to the lessee. There is an identified asset, and what is the lease term. Now, what happens is sometimes the contract contains a lease component as well as a non-lease component. So, as per Ind AS 116, the lessee, the entity basically is required to separate these two components. And when these two components are separated, the consideration is allocated. So, we will take a practical example for to understand this entire case, right? So for now, let's just understand that when there are lease component and another non-lease component in a single contract, then the lessee is required to separate these two contracts. And what factors it will consider while separating, that whether the components are individually beneficial, and whether the assets are independent of each other. So if there are multiple lease components, then also it will separate those lease components based on the assessment that the assets are individually beneficial and they are independent of other assets. And if there is also a non-lease component, in that case it anyway has to separate that component, right? But also there is an option that if the lessee wants, it can club and consider all the lease components as one. So it is recommended that they should separate all the lease components and non-lease component. But if they want, they can consider all the lease components as single component, and non-lease component will be separated anyhow. Now, before moving on to the practical case, we just need to understand what are the future lease payments. So, when we understood that now the lessees are required to represent a liability and an asset, right? So what will be the measurement, what will be the amount at which the liability is required to be reflected in the balance sheet, and what will be the amount of asset. So in order to calculate the liability, what is a lease liability? Lease liability is basically the future lease payments that the lessee is required to make. That is the liability of the lessee. Right. Now, what all will be considered in the future lease payments? What all will be considered while calculating the liability? So, these are the future lease payments that the lessee will discount, and we will understand how it will discount and what will be the rate. Right. So, the future lease payments are discounted, and then we arrive at the lease liability amount. So, to understand what are the future lease payments components, here is a presentation in front of you. So when we talk about future lease payments from the point of view of the lessee, there are five components. Number one is the fixed payments, right? Fixed payments that is usually in any contract. Number second is variable lease payments that are dependent upon any index or a rate. Right. So this is one interesting factor. We need to understand this. We will understand this after this. Third component is the exercise price of a purchase option. Now, this purchase option may be incorporated in the contract, and this exercise price is included in the future lease payments only when the lessee is expected to exercise that purchase option. If lessee is not expecting to exercise that purchase option, in that case the exercise price of the purchase option will not be included. Similar is the case with the penalties. Now, what happens with the penalties? If there is a termination clause in the contract and there is a penalty associated with that, and if lessee termination option, then it will consider penalties as a part of future lease payments. Right? So these two components, the exercise price and the penalties, is dependent upon whether the lessee is going to exercise that particular option or not. Otherwise, fixed payments and variable payments that are dependent upon an index or a rate is definitely included. And the last part is residual value that is guaranteed by the lessee. So if the lessee has guaranteed a residual value, that component is also included in the future lease payments. So there are just five components from the perspective of the lessee: fixed payments, variable payments that are dependent upon any index or a rate, exercise price of a purchase option if the lessee is going to exercise or not, then penalties of the termination clause if the lessee is going to exercise the termination option, and the residual value guaranteed by the lessee. These five components makes the future lease payments for the lessee. Now, what is the difference between future lease payments for lessor and for lessee? There is just one component additional in case of lessor, which is residual value guaranteed to the lessor by third party, which might be related or might be not related to the lessee. So these five components plus this another component, which is residual value guaranteed by any other party, makes the future lease payments for lessor. Now, the interesting factor in this entire slide is variable lease payments. Now, let me just tell you that in calculating the future lease payments, only the variable lease payments which are dependent upon any index or rate is considered. Right. So, variable lease payments which might be dependent upon, say, sales of the lessee is not included in this case. Right. So variable lease payments that do not depend on any index or rate, that are not in substance fixed and hence are not included in lease payments, they are charged to P&L as and when they occur. So when lease payments are dependent or linked to the revenue or sales or say any usage by the lessee, in that case it is not included in the future lease payments, but it will be expensed off as and when they are incurred. Now let's understand and clear the fog from the lease payments part, and let's understand what all will be included in the future lease payments. So the case is, okay, so there is a question, what if there is a revenue share component in a lease contract? Would that be lease or non-lease component? So when there is a revenue share component, that is definitely a lease component, depending all other conditions are satisfied. And the revenue share component will still be like it will depend what are the terms and conditions of the lease. If it depends that if the entire lease depends upon the revenue of the lessee, then it will be a variable lease component and it will not be included in the future lease payments. In case there is no penalty in whole lease term, then our measurements will be correct where penalties are considered. In case there is no penalty in whole lease term, then our measurements will be correct when penalties are considered. Sorry, I am not able to understand your question. So, if you're trying to say that there is no penalty, if there are no penalties in the entire contract, right, then obviously it will not be considered in the future lease payments. Okay, now so coming back to the question, there is a company which has taken an office building on lease for 20 years. For 20 years, the building has been taken on lease. And as per the contract, the company will make following annual payments: fixed lease rentals of 1 lakh, maintenance charges, which includes the CAM charges or service maintenance charges of 50,000. Then there is a property tax of 20,000, and there is a building insurance of 10,000. Now, I need to understand what will be considered in the future lease payment and what not will be considered in the future lease payment. Because remember that we are required to separate the lease component and non-lease component. Now, whether the maintenance charges, the CAM charges, are lease component or non-lease components. First of all, the maintenance charges are non-lease components. So definitely there is a different leg in this entire contract, that is a non-lease component. Now the question arises for property taxes and building insurance, because obviously lease rentals are for lease, right? So that is a lease component. Maintenance charges are non-lease components. Property taxes and building insurance, whether these are lease components or non-lease components, and whether they are required to be separated or not. So let me tell you, the property taxes and building insurance is not a separate component. These are these are just any payments which do not serve any goods or services to the entity. Right? These are certain payments that the lessee is required to make. It is not serving any asset or any service to the lessee. Right? So these are not separate components. Now, how the calculation will be done in this case? These are four components: 1 lakh for fixed lease rentals, then maintenance charges of 50,000, property taxes of 20, and building insurance of 10,000. So the total consideration for this contract is 1 lakh 80,000. But the only lease component in this case is the building rent, the rentals, right? And the maintenance charges, maintenance services are non-lease component. So these two components will be bifurcated, and the entire consideration of 1 lakh 80,000 will be allocated between these two components on standalone selling prices. So a ratio will be calculated for lease component and non-lease component. As you can see in this case, the standalone price for lease component is 1 lakh, and for non-lease component is 50,000. So a weightage has been calculated, and 1 lakh 80,000 has been bifurcated in these two parts. Now you can see that 1 lakh 20,000 is the annual payment for lease component, which is the building rent, and rest 60,000 is the maintenance services, is the non-lease component, and it will be expensed off as and when it is incurred. Now, if anybody has a doubt in this case, then we'll be happy to take. Otherwise, we will just move on.
Friends, if you have queries till now, you can ask your queries. We will take your queries. Otherwise, we will move ahead. So we will wait for your queries in the chat box. Any queries you have, you can ask your query. Also, you can like this video. Also, please share this video with your friends so that maximum participants can get the benefit of our today's session.
Okay. So, if you have any queries, you can always post here. But for now, I guess we will just move on. Now, when I talked about computing lease liability, there were two components, right? First is future lease payments, which we just discussed, and second is now those future lease payments will be required to be discounted, right? So we will need an interest rate, right? We will need an interest rate to discount those future lease payments. So the Ind AS 116 has given two kind of interest rates for the lessees to be able to discount these future lease payments. Number one is the interest rate implicit in the lease. This is the rate at which the net investment in lease is equal to the fair value of the asset. But if this rate is not available, now what happens is interest rate implicit in lease is calculated by the lessor, because this is from the point of view of the lessor. And then this rate is shared with the lessee. But in case lessee is not able to get this rate, it can always use the incremental borrowing rate. Right. Now, incremental borrowing rate will be considered when incremental borrowing rate will be considered for a similar kind of an asset for a similar term under similar circumstances. So, even though the company has no borrowings as of now, but it may consider an incremental borrowing rate. Like if the company was to borrow certain funds for this asset, then what would have been the borrowing rate? So there are two options given: the implicit rate that will be calculated and incremental borrowing rate that the lessee might consider in case it is not able to get the interest rate implicit. Now also, what happens is there are certain initial direct costs associated with the lease. What is an initial direct cost? This is an incremental cost, right? This is a cost that entities incur only when the lease is obtained, right? So if the lease was not obtained, this cost would not have been incurred. This is that kind of cost. For example, the legal fees, the documentation fees for the lease contract, or any other commission kind of a fees, right? So these costs are considered as initial direct costs. And what is the treatment of these costs, that we will understand. So now we have come on the initial recognition part. So as we all know now that lessee is required to capitalize all the leases, it is required to recognize an asset which is called as right of use asset, in short ROU asset. And on the other hand, it is required to recognize a lease liability. Now, what will be how the measurement will be done? That also we all have understood. Lease liability is computed by discounting the future lease payments using the interest rate implicit in lease or the incremental borrowing rate of the lessee. Right. This is one component of the ROU asset. Other component is if the lessee has already made certain rental payment, if the lessee has already made a lease payment, because in lease liability only the unpaid portion is covered. But what if the lessee has already made payment in advance? In that case, it is not considered in the lease liability, but it will be considered in the ROU asset. And the initial direct cost that we just discussed, if the lessee has incurred any initial direct cost, that cost is also included in the value of ROU asset. Other than this, there is also another part which is the provision for dismantling or removing the underlying cost. So basically what happens is, suppose the company has taken a machinery on lease, and now after the end of this, after the expiry of this lease term, the company is required to dismantle that machinery. Right now, there will be some cost associated with the dismantling. So that cost is also required to be included in the ROU asset. And how will we calculate that cost? The lessee will estimate that future cost, will discount that cost using the same rate that it used to calculate the lease liability, and will be included in the ROU asset. So I hope the initial recognition part for the lessee is also clear. This is very simple, like just an asset and a liability is required to be computed. Now we move on to the subsequent measurement. Now, since at the initial recognition, the lessee recognizes an asset, so now it will depreciate that asset. How the depreciation will be calculated? What will be the measurement? So, as per Ind AS 116, the lessee has been given an option. It can either go for cost model as per Ind AS 16, or it can either go for revaluation model as per Ind AS 16. So in case of cost model, what happens is the depreciation is calculated, and the carrying amount at the end of the year is cost minus accumulated depreciation minus any accumulated impairment. Now, the only catch in this case is what will be the depreciation period, because we all know how to calculate depreciation, right? But what will be the depreciation period in case of leases? So, in this case, if the lessee has a purchase option in the contract and it is going to exercise that option, right? There is an intention to purchase that asset. In that case, the entire useful life of the asset is the depreciation period. But if there is no such purchase option, then it will be the earlier of useful life or period of use. That means the lease term of the contract. So, only thing need to that is required to be understand in this case is depreciation period, which is either the useful life of the asset if the lessee intends to purchase it, or the earlier of the useful life of the period of use. That means the lease term. Now, what happens with the lease liability? Obviously, we have recognized the lease liability at the initial recognition. So, the lessee will charge interest on the lease liability, and that interest charge will be recognized as finance cost in the P&L, and whatever the actual lease payment is done, it will be adjusted in the balance of liability. It is as simple as that. Now, we have understood the treatment in the books of lessee. What happens with the lessor? So, as we clearly understood that there has been no such change in the accounting treatment of leases in the books of lessor. Right, lessor is still required to classify the leases at inception date between finance lease and operating lease. Finance lease is what? Finance lease is a lease in which the lessor transfers substantially all the risks and rewards incidental to the ownership of the asset. Means there are certain circumstances that clearly reflect that all the risks and rewards have been transferred. Right. For example, the lease term covers maximum period for the economic life of the asset, or say there is a purchase option in the lease and the lessee has an option to purchase the asset at a very minimal value, right? So there are certain examples given in Ind AS 116 that may be considered while assessing whether the lease is a finance lease or an operating lease. So clearly, whatever lease that is not a finance lease is an operating lease. Now, what happens at the initial recognition? How the lease is recognized? In case it is a finance lease, that means the substantial risks and rewards have been transferred. So in that case, what happens is the asset is de-recognized from the books of the lessor. It will credit the asset account and it will recognize a receivable, finance lease receivable in the books, and whatever the difference is there, it will go to P&L. And in case of operating lease, initially there is no recognition, obviously, but subsequently, in case of operating lease, whatever the lease payments it receives, it will be recognized directly in P&L on an SLM basis. SLM, straight line method of recognizing lease income, is nothing but total lease payments divided by the lease term. So basically, we just equalize all the payments, right? So if there is any escalations between, or there is a rent free period, so every year same amount will be recognized. And what happens with the lease receivable that was recognized at the initial recognition? Same as the lease liability. In case of lessee, interest income will be charged in P&L and actual receipts will be adjusted from the receivable account. So the lesser accounting has not changed, it is still same, and there is not much complication. So this standard also talks about the modification. So let me just cover the modification part quickly and then we will move on. So modification is nothing but if there is any change in the scope of lease or there is a change in consideration for lease. Right, this standard clearly specifies that for a change to qualify as a modification, there has to be a change in the scope, which can be either by adding or terminating or deleting an asset from the contract or by changing the lease term. Right, so these these two components may be used to change the scope of the lease, or if there is a change in the consideration for lease, right? If the consideration has been changed, but these two changes need not be a part of original terms and conditions of the lease. That means if these are new changes that was not in there, that was not there in the contract earlier, then only these changes will be considered as lease modification. Now, when there is a lease modification and there is a change in scope which increases the scope by adding another asset, if there is a situation in which the scope has been increased by adding another asset and the consideration has been changed with respect to its standalone price. For example, a company has taken four machineries on lease. Now, after 3 years, company realizes that it needs another machinery, right? So it approaches the lessor, and the lessor gives another machinery. So now the lessee has total five machineries, but the another machinery, the fifth machine that the lessee has got, the consideration for that machine is is related to the standalone price or the market value of that machinery, right? The rental payments for that machinery is equal to the market value or near to the market value. In that case, the accounting, the change in the contract due to addition of that fifth machinery will be accounted for as a separate lease. That means a new lease will be recognized for that particular fifth machine, because there has been an increase in scope and the consideration has been increased, which is equivalent to the standalone price of that increase. So there is a question: term of lease is less than 12 months but has renewal clause. Will I calculate lease liability? So, Konika, if at the time of commencement date, the lessee will assess whether it is going to renew the lease contract or not. If yes, then obviously it will be accounted for as the normal accounting treatment given in Ind AS 116, and lease liability will be computed. But if not, and the lease term still remains less than 12 months, then it may avail the exemption given and it may account for the lease as operating lease and will recognize the lease payments on SLM basis, and there is no need to calculate the lease liability. Nishtha is asking how finance lease receivable will be calculated. Finance lease receivable is calculated by looking at the net investment in the lease. Net investment is nothing but the payments that the lessor is expected to receive, right? That is discounted. Those payments are discounted using the interest rate implicit in lease, and that is how the lease receivable is calculated. Yes. Great. So we now understand that modification, a lease modification that results in increase in scope and corresponding increase in consideration, which is commensurate with the standalone price of the increase in scope, will be accounted for as a separate lease. But what happens for other lease modifications? So if there is another any other kind of lease modification that cannot be accounted for as a separate lease, it will be accounted for by reassessing the lease liability, right? When we talk about lessee, the lessee will reassess the lease liability by calculating a revised lease liability. How the revised lease liability will be calculated? It will discount the revised lease payments at revised discount rate. So on the date of modification, the lessee will calculate a revised discount rate. It will calculate the revised lease payments and will discount the same. And whatever the adjustment is there in the lease liability will be done from ROU asset. So the balance of ROU asset will be adjusted. But if there is no lease modification at all, but still there are certain changes, suppose there is a change in guaranteed residual value, or there is a change in variability of lease payments, right? So in that case, what happens is the lessee is not required to calculate the revised discount rate. It can still use the original discount rate, but it is still required to reassess the lease liability, and whatever difference is there between the carrying amount of the lease liability and the revised lease liability will be adjusted from the ROU asset. So regarding this, there has been an amendment brought on 24th July 2020. So day before yesterday, Alok sir took the session on the overview and amendments, and he talked about all the amendments very comprehensively, right? But he told all of you that any amendment regarding Ind AS 116 will be considered in this session. So on 24th July, MCA notified an amendment, and what basically the amendment was for. It was for COVID 19 related rent concessions. So, what happened was in March, as we all know, the COVID 19 was declared as pandemic, right? And since Ind AS 116 is converged from IFRS 16, which is issued by IASB. So, whatever the amendments that IASB brings, we in India amends our standards to align our standards with the IFRS, right? The International Accounting Standards. So in May 2020, IASB brought an amendment in IFRS 16 to provide relief to the lessees in COVID-19 pandemic. And similarly, in July, on the same lines, MCA issued the same amendment to Ind AS 116 on COVID-19 related rent concessions. So basically, what is this amendment? What has actually happened? During this COVID 19 pandemic, a lot of lessors have given rent concessions to the lessees, right? Be it in terms of reducing the lease payments, or be it in terms of completely zero lease payments, right? A lot of us have must have heard about the force majeure clause, due to which the lessees are not required to make lease payments during a certain period of time, right? So all these rent concessions, reduction in lease payments, or whatever kind of concession is there, these concessions have been removed from the IFRS 16 and
Friends, I think there is some network issue. So let me connect with Chandni and then we will start the session again. So in the meantime, if you have any queries, you can write your queries in the chat box. Whatever your queries is, please write into the chat box. So Chandni is joining soon. Just give us some minutes.
so basically, this amendment has brought a relief to all the lessees. It has been a practical expedient in which the lessees are not required to assess whether a rent concession is a lease modification, and will account for that rent concession as any other change in lease liability. Now, how the accounting will happen, and what is actually the rent concessions that is considered for this amendment? First of all, this amendment is applicable, is effective from 1st April 2020, right? But for the companies who have not issued their financial statements yet, they can also apply this expedient in financial year 2019-20. Now, this expedient is applicable only to the rent concessions that occur as a direct consequence of the COVID 19 pandemic. That means the revised consideration. The revised consideration means whatever the change has been made in the consideration due to rent concessions, the revised consideration ultimately is either equal or less than the consideration which was earlier than the rent concessions. So basically, there should not be any increase, because obviously this is for rent concessions, right? So there has to be either a decrease, or there should not be any change in the consideration. Second part is the lease payments, the reduction whatever happens in the lease payments should affect the payments which are due on or before June 30th, 2021. So, whatever the payments are due before 30th June 2021 will be covered by this amendment. Otherwise, this amendment cannot be applied for payments which are due after 30th June 2021. So, there is a limitation from 1st April 2020 to 30th June 2021. Whatever the payments that are due between this period only will be covered under this amendment. And the third condition is there should not be any substantive change in any other terms and conditions of the lease. So if there is any other change in terms and conditions of the lease, because now due to this amendment, there might be certain companies who change their leases, any other terms and conditions of the lease, and still apply this practical expedient, right? So in order to avoid such malpractices, the boards have made it clear that there should not be any other change in the lease agreement. So, if these conditions are fulfilled, if this is the rent concession that has been occurred as a direct consequence of the COVID-19 pandemic, then only this practical expedient can be applied. Now, this practical expedient is very clearly giving a relief to the lessees. They are not required to assess if the change in consideration is a lease modification or not. They can simply calculate whatever the benefit is there and recognize in profit and loss account. So, generally, when there is a lease modification, the lessees are required to calculate a revised lease liability and adjust an ROU asset. So there is no impacting P&L, right? Whatever benefit, if there is a reduction in lease liability, then it will be adjusted from ROU asset, and if there is an increase in lease liability, then also it is adjusted from ROU asset. But in this case, the relief has been given and a benefit has been given to the lessees, and it has been made clear that whatever benefit is there on account of decrease in lease liability will be recognized in profit and loss account. So there is a dual benefit to the lessees. First, they will be saved from extra efforts by assessing whether a change in consideration a lease modification or not, because for companies who have for companies which have a lot of lease contracts, it is a very hefty task to assess whether a change in a particular contract is a lease modification or not, right? So they are saved from this effort, and also additional benefit in the P&L has been given. I hope this is clear to everyone. Can there be difference in finance lease receivable and asset credited in the books of lessor? Yes, Nisha. So if there is any difference between the finance lease receivable recognized and the asset already recognized in books and now being de-recognized, in that case, the difference is recognized in profit and loss account. I hope I'm audible. Am I audible?
Yes, Shan, you're audible. You're audible.
Oh, okay, okay. So I guess some people were not able to hear. Okay.
No, you're audible. In the earlier, there was a glitch of 5 7 seconds. So
Okay,
that
okay,
time
okay.
I've explained, and now you're completely audible. You can continue. You can move ahead.
Okay. Perfect. So I hope everyone is clear on this part, right? So if there is any rent concession which has occurred due to COVID-19 pandemic, every lessee is requested to be aware of this amendment, and they can totally avail this exception. It will save their efforts and also give a benefit in their P&L. Perfect. So now we will just discuss quickly three more topics which are there in this Ind AS, and it will not take much of time. So this is the lease of land and building. So now what happens in case there is a land and there is a building as well? So this topic is considered separately. Why? Because land has an indefinite useful life. Everyone is aware of this, right? But buildings have a limited useful life. So while assessing whether a lease contract is a finance lease or an operating lease, and if the asset is land and building both together, then how do we assess? Because for finance lease, there is a criteria called useful life criteria, in which we see if the lease term is for majority of the useful life of the asset. In that case, the contract is classified as finance lease, right? But when there is a land as an asset, there is no economic life, because land has an indefinite economic life. Then how the entity will compare, and how the entity will determine if it's a finance lease or not? So in that case, the standard has clearly made it clear that the classification will be done separately. So the land and building will be separated. The consideration will be apportioned between these two components in their fair values, in proportion of their fair values at the inception date. And the land part will be considered as operating lease, because the land has an indefinite useful life, right? But the building, for building, an assessment, a proper assessment will be done whether it's a finance lease or an operating lease. Right. So I hope this is clear. But also, the standard states that if the amount of land is immaterial, then it may consider it as a single unit, and there is no need to separate the both the components. So there is another clause. There is another guidance in Ind AS 116 about sale and leaseback transaction. Now, what happens in this kind of a transaction? The seller, which deals in a particular kind of asset, makes a normal sale to a buyer. Suppose company A has sold a machinery to company B, and company A is the dealer of that particular machinery. But now what happens is, company A sells the machinery to company B, but company A takes that machinery again on lease. So now company A and company B, which were earlier seller and buyer, have now become lessee and lessor. So company A has sold the machinery but still have the machinery, but now on lease, right? So company A earlier was a seller but now has become a lessee, and company B earlier was a buyer but now has become a lessor. So what happens in this case? What happens in this kind of a transaction? Ind AS 116 clarifies that in such a situation, the assessment needs to be done under Ind AS 115. If the original sale qualifies as a sale under Ind AS 115, which is on revenues from revenues from customer contracts, contracts with customer. In that case, if it qualifies as a sale, the seller, or now the lessee, will recognize gain or loss only on the rights transferred to the buyer, and recognize an ROU asset for the portion of carrying amount pertaining to the rights retained. Right. So basically, now what has happened? If it is a sale, if it qualifies as a sale under Ind AS 115, the lessee, which was earlier the lessor, will recognize profit or loss in the P&L only for the rights that have been transferred, right? Because there are now bifurcation of the rights, a right that has been actually transferred and a right that has been retained in terms of ROU asset. So the right that has been retained in terms of ROU asset will be recognized as an asset, and a corresponding liability will be recognized. But for the rights that have been transferred, the seller will recognize a gain or loss in the P&L. But what if it's not a sale? Right? If it does not qualify as a sale, in that case, what happens is, seller recognizes a financial liability for the amount received, and the accounting for lease will happen as usual. And the finance liability will be adjusted from the lease payments that it makes, and the buyer will recognize a financial asset and will adjust the payments that it receives from the financial asset. So basically, it goes under Ind AS 109. So this concept is very simple. I hope everyone is able to understand this. Just that the less seller is required to bifurcate the rights that have been transferred and that have been retained. And the gain or loss will be recognized for the rights transferred, and for the rights retained, or ROU asset will be recognized and corresponding liability will be recognized. Now, another important concept in this standard is sublease. Now, what is a sublease and what happens in sublease? Sublease is, suppose company A has taken a machinery on lease from company B, but now company A has further leased out that machinery to company C. So, company A is the intermediate lessor because it was the original lessee. Company B is the head lessor, which originally leased out that machinery to company A, and company C is the sublessee to whom company A has leased out that asset. So, for company B, which is the head lessor of the original lease, the accounting remains same. Further, for sublessee, which is the company C, again the accounting remains same as per the other provision of other guidance in the Ind AS 116. But for intermediate lessor, that is the company A, the accounting and the guidance is still a little twisted, right? So in this case, the company needs to assess if the sublease will be classified as a finance lease or an operating lease, because now the lessee has become a lessor, right? For the main lease, company A is a lessee, but for the sublease, company A is a lessor. So now, as a lessor, the company A will require to classify the lease into finance lease or operating lease, right? So, how the assessment will be done? So, there are two things that need to be kept in mind. Number one, if the sublease is for a period of 12 months or less, that means it is a short term lease. In that case, anyway, it will be classified as a operating lease. But if it is not for 12 months or less, it is for more than 12 months. In that case, the lessor will require to compare the period of sublease with the period of the main lease. That means the ROU asset of the main lease will be compared with the ROU asset of the sublease. So generally what happens in case of finance lease, we see, uh, suppose company A has taken that machinery from company B in the original lease for 5 years, right? And the economic life of that machinery is nothing but 10 years, right? But now company A has subsequently leased out that machinery to company C for 2 years. Now what happened? 5 years is the lease term for the original lease. This 5 years will be compared with the economic life for the main lease part. But for sublease, 3 years of sublease term will be compared with the 5 years of the main lease and not with the 10 years of the economic life of the asset. So that is the only thing that is required to be kept in mind while assessing the term or the classification of the sublease. Also, another catch in this is when there is a lease of low value, right? As we understood initially, the exemption given in this standard is for low value lease and short term leases. So when there is a lease which is of low value and exemption has been claimed for that, in that case, in that case the if there is a sublease part in the low value lease, in that case the exemption cannot be claimed, right? So if there is a lease which is actually of low value but the lessee is intending to sublease it, then it cannot claim the exemption for low value lease. So I hope this is clear. Okay, so Konica, my company pays lease rent for using MMB port. Will I classify this as ROU asset? So we need to understand what exactly the asset is in this case, right? And if the asset is an identified asset and there is a lease, then obviously ROU asset needs to be recognized in that case. Mr. Ravi is saying sale and lease back is not easy. I guess we need to check some practical questions. So obviously, see, the concept is easy, but while applying it practically, there may be certain other factors that need to be considered, right? So, but because we have limited time for this session, so we cannot take a practical question, but definitely you can connect with me after this session, and then we can probably work this out. So, sir, I guess I'm done, and we will be happy to take any queries if there are any.
Thank you, Chandni, for have a wonderful session. And in the meantime, within the session also, you have resolved many queries. You have replied many queries. So still, friends, if you have any queries, you can ask your queries. We will take your queries. We are here to take your queries. And thank you all the participants, those who have joined. And once again, thank you, Chandni, as well.
Thank
So
you so
now
much,
let's
sir.
move to the query session. So please ask your queries. We will take up your query. So Mr. Ravi जी की query हो गई क्या मैम? That sale and lease back is not a easy. Now Jabir जी की query आ रही है. What is the ROU life to be considered to treat as operating lease?
What is the ROU life to be considered to treat as operating lease? So, first of all, the concept of classification of finance lease and operating lease has been discarded, right? So, there is no ROU in case of operating lease. So, if we are talking from the perspective of lessee, there is no ROU to be recognized in case of operating lease. Only the lease rentals that are paid will be expensed of when, as and when they are incurred or on SLM basis. Thank you,
Thank
Nishtha.
you, Nishta ji. And I request all the participants to give your feedback as well. We will wait for your feedback because your feedback is a appreciation for us, for a speaker and as well as for a organizer. So I request you kindly provide your feedback, and if you have queries, you can ask your queries. If you do not have queries, please give the feedback. Also, please like this video. Also, please like this
Okay,
video. So Jabir is
okay.
saying I
So
am taking in case of the sublease.
okay, so sir, in case of sublease, we will have to compare the period of sublease, the lease term in the sublease contract, with the lease term in the main lease contract. So we are not required to compare the lease term in the sublease contract with the economic life of the lease that would have been the case in main lease. So ROU, so the purpose of looking at the ROU life is that only that we need to compare the sublease term with the main lease term. As we took an example that suppose a machinery has a 10 years of life and the main lease was for 5 years, but now the sublease is for 3 years only. So for main lease, the lessor would have compared 5 years with 10 years. But for sublease, 3 years will be compared with the 5 years and not with the 10 years.
Shani can
Thank
see the
you.
comments, and thank you, Alok ji. You were here since last 2 hours, so thank you for being with us. And अभी जिसने भी like नहीं करा वीडियो को, my humble request to like this video, to subscribe our channel, and to share this video with your friends and colleagues so that maximum people can take the benefit. And one link of the Alokji book I was shared again. If those who have joined late, basically Alok ji की एक book आई है, which he has published in his second book. सो वो बुक की प्री डिलीवरी पे अगर कोई लेना चाहते हैं तो आप में से कोई भी वो बुक परचेज कर सकते हैं. मेरी पुस्तक डॉट कॉम पे बुक अवेलेबल है, वहाँ से आप मिल जाएगा आपको बुक. एंड चांदनी दीज कमेंट्स आर कमिंग फॉर यू. थैंक यू चांदनी. एंड जस्ट
Thank
टू
you so
कंफर्म,
much.
लेट्स नेहा चौकसी.
Just to confirm, after Ind AS 116, PBIT increases due to non-consideration of depreciation on ROU and lease interest as before Ind AS, these would have formed part of lease rent. Yes, of course, Miss Neha, after Ind AS 116, the EBITDA, so basically the profits before depreciation, interest, and taxes will increase because now the operating expense that was earlier recognized before uh, EBITDA or PBDIT will now be recognized in depreciation and finance cost, which comes below PBDIT. So obviously the PBDIT will increase. Thank you. Thank you so much.
Thank you everyone for your appreciation comments. Also, we request you kindly like this video as well if you have not yet liked it.
So, Mr. Ravi, whatever your query, I guess we have missed. So maybe you can just post it again, or you can just connect with me after this session and we can take up your query. No problem.
So, Vijay, you can ask your query once again. If we have missed it, we will take your query. We are waiting for other queries. If there is any other query, we will take the queries. PPT will be uploaded on our Telegram channel, Study Cafe Telegram channel. You just need to search Study Cafe in the Telegram, and then you will be able to see the Telegram channel. From there, you can download the PPT. We will upload PPT once I'll receive the PPT from Chandni.
And
And
also,
once again, yeah,
sorry.
yeah, Chandni, continue.
Yeah. Yeah, so I was just
Yeah.
saying that whatever examples I've taken in this session, you if you want to get like a lot of more examples on this index and other indices, obviously the book that has been written by Alok sir, Treatise on Index, for which the link has been shared by Deepak sir, you can always look at that book, and that book contains a lot of practical examples and a lot of MCQs to make you understand in a simplified manner.
So this is a link which has already been given in the chat box. From this link, you can purchase the book. Also, link will be up available in the description because there will be many participants in the session. So I will update this link in the description. One query of Ravi is here. Chan, you can see the query.
Yeah. In sublease concept, the lessee become the lessor, so now lessee needs to recognize ROU from balance sheet. Which lessee? Yes, of course. So when the in case of sublease, when the lessee has now become the lessor, and it classifies the lease as a finance lease, it will have to de-recognize the ROU from its balance sheet. But if it classifies the sublease as an operating lease, in that case, the ROU will not be de-recognized, and whatever the lease payments it receives will be recognized on SLM basis. I hope it solves your query, Ravi. Thank you. Sir, I guess you're on mute. Can't hear you.
So I'm saying, still, if you have any queries, friends, you can ask your queries. PPT will be available on our Study Cafe Telegram channel. From there, you can download the PPT. If you have any queries after the session, also you can contact Chandni as well. Chandni has
Yes.
given her details. Let me share her details once again. So here are the details of the Chandni. You can contact Chandni as well after the class. So Raviji is saying thank you. Thanks a lot, Raviji.
Thank you so much. It was a wonderful interaction with everyone, and thanks to Deepak sir for having me here. Lovely audience.
Thank, thank you, Chandni, and thanks a lot all the participants for joining us. Even after lockdown, there was so much good participants. We are glad to have all of you here. So in the weekday also, and considering the office has opened. So there was very good number of participants. So we are thankful to each one of you from bottom of our heart. And thank you, Chandni, once again for being with us and for taking the session
Thank you
so
so much.
excellently. Because earlier also we had a session on leases when we had India series. So that time there has been many participants were saying it was not good or what there were some issues. But now we got the feedback as well. So it has been very good session, very informative session. Thanks a lot to you.
Thank you so much.
So now we are winding up our session and goodbye to everyone and good night to everyone.
Thank you so much.